update to the wider IAB Europe forum, providing a first assessment, quantifying the impact. And now it's time to give an update. So what has changed in this 1 month? A lot has changed because we are in a highly volatile and extremely liquid environment. So the good news is, in all the bad, that there are some signs for improvement. And it looks like the ad market is going to be able to recover slightly faster than many analysts initially assumed. So about this presentation, I will talk about numbers, market sizes and forecasts, an update from my first assessment in April. It's clear to bear in mind what the objective of this presentation is. It's not to provide an ultimate truth. We just don't know. There are so many uncertainties about how the economy is going, political responses, and also whether there will be a second wave of COVID-19, for instance. Too many things, too many puzzle pieces together, actually, that really make it very hard to forecast. We also know that what happens in one country might affect another country and so forth. So when you read this presentation and the numbers in here, think about it as signposts, as frameworks and how you can think about the future based on what we know. It will change ultimately. I will revise the forecasts every month, but it should give us some direction of what factors to consider and what a scope of potential possibilities might be. But please always be critical, be skeptical. Don't take it as the ultimate truth. Now, what tools do we have available? What can we do to analyze the impact on the ad market? We hear specialists in our industry press, we hear reports, we see headlines in the news, we see economic factors being put out by research institutes. So what do we have at our disposal? Let's look at the left of the screen. We have our macroeconomic modeling, which means we look at how ad spend relates to overall economic growth, and we look at data from the International Monetary Fund, from the OECD, from national statistics offices, and we try to build a model that correlates how advertising would look like in a certain economic outlook. This has worked really well in past recessions, but this one's different. Too many factors. So it's not the perfect way of doing it. Then the second is a so-called sectoral impact model. That's what many financial analysts do when they want to evaluate the performance of a company, for instance, of a Facebook, a Google, or a Central European media enterprises. And they look at the relative exposure of an advertiser vertical, healthcare, travel, FMCG, and so forth, to the crisis, and then look how exposed is a company to these different sectors. And they build a model on that basis. That tends to work well for individual companies, but not for the overall market. Also, as we've seen, not every company in each sector behaves the same right now. So for instance, look at recent reports just in the FMCG category. Procter & Gamble was investing more in advertising in the crisis. Unilever was shifting budgets but keeping the overall pie flat, whereas Mondelez was actually cutting spend. So very, very different things happening, which doesn't make the sectoral impact model the best. We have our industry experts, our surveys. Quickly we can use them, but what we see in the surveys is not always that which we see in the company results. And that was a key thing in this presentation. So we at IAB Europe, we did some surveys which said social and search were going to decline by 30%, for instance, in March. But if we look at the company reports of the Google and the Facebook, we can't find those numbers. Growth was much more healthy. We lastly have the financial filings as well, and I mentioned those already, and often the industry surveys and the filings, they clash. So I took the macroeconomic modeling, I took industry surveys, and also now the Q1 industry filings to give an update on what's going on. Quick recap. Why did I do this? Ad spend is highly correlated to economic growth. You can see this on the left. You see several years of GDP growth, and ad growth really correlates very strongly. There are three things. There's the GDP, there's household consumption, so goods being consumed, and also industrial production, the indicator for the demand. Now, what's interesting is that not only is ad expenditure, ad growth correlated, but it amplifies economic trends. So here's an example from the US, and if you look at the left of this chart, you can see in previous years up to 1990, you could see that advertising was in good and in bad years amplifying economic growth. So when the economy was healthy, ad spend was growing more, and if the economy was doing badly, ad spend was doing even worse. What we have seen as a shift since around 2000 is that ad spend isn't really growing anymore when the economy is growing, or not growing as much anymore, but it still amplifies the downward trend. And that's something we have to deal with right now. The huge issue for now is we need other economic indicators. What you see here is a global policy uncertainty index, which looks at basically, do news reports, do economists, do specialists, do they agree on the outlook for the economy? And never ever have so many experts disagreed on where the economy is going, which makes forecasting quite difficult to do. So huge uncertainty. Now, bearing in mind there is a correlation between ad spend and the economy. If we look at the US data, where we have the longest ad spend data on record up until 1990, we can brace for an ad recession of historic proportions. So if we take the IMF, the International Monetary Fund's baseline GDP scenario, and correlate that with how ad spend usually behaves with GDP, we are in the US for the greatest ad recession since the Great Recession economic downturn in 1929. But as I said, not all economic forecasters agree. So if we instead take the Deloitte GDP forecast for the US, things look worse. And even 2020 could be the worst recession in the recorded history of advertising. Across European markets, we have a similar trend where we see this amplification of macroeconomic trends. Now, the good news is, since I did my last forecast, we have more signal. We have more and more reliable data to go on. So in gray on this timeline, you see key events happening that have shaped how the ad market is reacting. In pink, we can see signal events, so moments where we can gather insight. And we had very few of those up until now May, actually. Previously, we only had the first company reports from China with the first national economic data, with some surveys, and we had the GDP forecast, the big macroeconomic outlooks from the IMF, the OECD, from Deloitte and others. Right now, we also have the Q1 company reports, and that makes it much more robust, our modeling. And we've seen some actual numbers being put out on the Q1 market performance. And here are a couple. And even we do have the Romanian data as well, estimates for how the market performed in Q1, which is before the major impact really happened. And Romania was doing better than the rest. So this is data I took from the CME company reports, for instance, and other industry filings. And but we can see that the effect of COVID-19 doesn't really come out everywhere because there are other cyclical and structural drivers affecting the market. For instance, the incremental tax on the telecom, the banking sector last year in Romania, which really put a damper on spend in some categories. On a like-for-like basis now, the market grew stronger. However, we saw all markets in March started to see negative growth, but to a different extent. And we can see how severe and how sudden the deterioration of the environment was if we dive deeper into the role of March in the first quarter. Here's an example from the French Publisher Association. And you can see well, the overall quarter looked bad. It was really March that really drove it down, with major double-digit declines of 40, 65%, depending on the media category. Which means that in contrast to previous recessions, we've seen an extremely sudden reaction. There wasn't a gradual decline that the market could prepare for, but it went from 100 to nearly 0. So this is really different from what happened before. It was really a market crash, extremely sudden crash, and all media were affected. In previous recessions, digital was faring a bit better, but right now we can see, if we look at this data, everything was affected. Interestingly, we can see even digital doing slightly worse than traditional media, because there's a lag effect in there. In particular, when there are advanced booking commitments of a couple of months or even of a couple of weeks, we only see the full effect shining through for TV, for instance, for radio. We only see that really shining through in April. With digital, as a blessing and a curse, it can be switched on immediately, but it can also be switched off immediately, which makes the abrupt impact much more sudden right now, but which also provides a huge potential for digital when it comes to the pace of the recovery. A key issue to look at if we do forecasts is what were the government responses in select markets to the virus, because how much of the economic activity was shut down, how much a lockdown was in place, also affects what goods and services could be sold, for instance. And if we look at this government stringency index, I took 2 dates. I took April 1st, this is from the University of Oxford. I took April 1st because nearly all countries in Europe, which we cover here, did have lockdown measures and other government responses in place. I took May 11th, the latest data we have for all those markets, to see, has something changed? Have restrictions loosened? And then I took the combination of the stringency of the response and the change in the stringency of the response to see, do we see an easing of conditions from April to May, and therefore a more positive forecast. The outcome is this following outlook of 2020 ad spend. This is all media by market, based on GDP this is, and adjusted by government response. So this is model data, and it will change, but it gives a first indication of where we are standing. And you can see double-digit declines really in the vast majority of markets. There have been some changes to my forecast since April, and mostly improvements based on the government stringency index. And you can see here the markets on the bottom here. You can see the markets where I did those changes, and they were positive. And I might make some more positive changes given positive performances in May and June. Since the last forecast, what happened? The major revisions I made were in digital. And that was because the company results that came out from ad tech firms, from Google and Facebook, from Knapp, they were much better than anticipated. Analysts braced for the worst, but we could see little deterioration overall in the Q1 results. We saw, apparently, Google mentioned that search declined by a mid-single digit, mid-teens percent, so around 13, 14, 15% in March, and that a similar trend was happening in April, but then that a stabilization, a bottoming out was happening. Whereas Facebook indicated that growth was flat, or 0 in April, and not turning negative. And given the size of those two companies, I improved the forecast. And also, if we look at the ad tech companies, it was slightly better than expected. However, for traditional media, it was slightly worse as the out-of-home effect and the cinema effect became more severe. But for digital, this has been a good news. It showed a relative resilience, a stronger resilience than anticipated. So what is really, if we go into the detail behind these key factors for the revisions? Previously, if you look at the left side of this chart here, previously we assumed that that May and June were going to be equally as bad as May. But we have increased indications in company reports, also from agencies, that May is faring slightly less worse, not better in a sense, there's no growth, but less worse than April. And that June could look even better. And we can see this, for instance, we see lockdown measures being opened up. In Germany, my home market, the football, the Bundesliga is coming back, and so forth. So a slight easing of conditions. However, not everyone can benefit from this. We see that the walled gardens so far fared slightly better and will continue to recover more easily, mainly because they attract such a volume of advertiser spend of very, very diverse businesses, small, medium-sized enterprises, and so forth. However, I've also, out of this improvements, significantly downgraded the online classifieds market. I know in some markets it might be better, but in some large markets like the UK, like France, like Germany, like Spain, the market is getting really bad due to it being reliant around 40–50% on jobs, and there are none at the moment. So if we look into the different formats of digital by quarter, we can see a completely different trend. We saw nearly everything was positive in the first quarter. We saw some hits, you can see here on banner advertising, classifieds already. However, social, search, and video all were extremely strong. The main hit, as we can see, we expect now to take place in the second quarter, and then an easing of conditions overall in Q2. But you can see if you look at these media that if you go to other media, traditional media, that the impact is going to be more pronounced and it will take longer to recover. Whereas we already see a return to growth for social in the third quarter. Interestingly, in the last recession, it was search that rebounded extremely quickly. That wasn't even negative at all. But that was really the fastest driver in the recession. Not the case anymore. It's a much more mature market, but it is social that is now most resilient of all digital formats. Now, increasingly, that means that digital versus traditional, although we see on an aggregate level huge differences between the two, it's the wrong divide. It's the wrong distinction to make. We see huge differences across digital formats, and also about huge differences between the advertising strategies. Is it branding? Is it performance, etc.? And you can see if we zoom this out on a monthly model, look at the left side here, you can see how quickly direct response-based, performance-based media that drive e-commerce, for instance, how quickly they recover. You see how quickly social is recovering, followed by search. And then actually on the video, it's a two-sided thing. There's performance video, which is growing very strongly. Then we see a huge drop, a huge downturn in brand advertising video, but we expect it to return in September. And then banner display, the performance section, recovering as well this year, but to growth, but to a lesser extent, because it's more fragmented. It doesn't provide the same direct response characteristics as social and search, whereas other media are lagging behind significantly. A critical factor for recovery this year will be the fourth quarter. Now, in a sense, Q3 is already the new Q4, because if the market returns to growth in Q3, which we expect in some areas to happen right now, we have a great indication for the rest of the year. But the Q3 is always a very small quarter, the tiniest quarter in the year, and the real bulk, Q4 is the biggest quarter in the year. So what happens there will decide how quickly the market will recover overall. Now, right now, we can see travel, hospitality, automotive are the worst affected ones. We can see e-commerce is doing well right now, but not across the board. So food, online gaming, groceries, yes, but not e-commerce at the whole, which is for bigger items, washing machines and bigger acquisitions and so forth. So with this, there is a possibility of a stronger rebound in Q4, but it's highly sector dependent. Now we have some signal already, and we can take evidence from China. So what you see here is from a company called Edited. This is a company that tracks the availability of new fashion styles in online stores. So how fashion retailers are replenishing their stock and putting out new styles. And look at the UK here, where as the lockdown started, as really we had, and as the cases rose, we saw a massive drop down in 2020 in terms of new styles. People stopped shopping for clothes. They were at home, dispensable income was going down, and so forth. So a massive dip. We saw the same sudden dip at the bottom of this chart in China as well, when COVID-19 was really becoming strong. But now look at the rebound in China. As soon as conditions eased, very quickly, this sector was going up. And with similar indications, when we look at the, for instance, at the agency company reports, the WPP report states that Louis Vuitton and other luxury brands saw tremendous 50% increase, 50% higher than normal sales in China as the country moved out of lockdown. So there are some sectors which can really do this V-shaped recovery, very quickly, very suddenly reacting to positive market trends. For others, it will take much longer. If you think about automotive or other categories, where not only do you have to restart production, which is going to take weeks, but if production lines have been retooled to build other things, like ventilators, for instance, it takes time to rebuild things. Also, in terms of cost management, clients can't recover overnight. And if in the annual risk mitigation plan, marketing, which is usually seen as a discretionary expense, as we all know, if marketing has been cut, it's very difficult to restart it extremely quickly. Again, if sales aren't coming up. So it will take time for other parts of the economy to reboot, and they will not be part of this V-shaped recovery that some sectors are very likely to show. So we will have to wait in some sectors for a 2021 recovery, but there's good news. We now have at least some evidence that if the conditions improve, some advertisers will be back with a vengeance. Now, of course, not all sectors, as you all know, and you will have done your own analysis, are exposed in the same way. This is from our IAB Europe pan-European survey that looks at data from January to the beginning of April to understand where has spend happened and what are actually sectors that have been increasing spend. And we see a couple that have actually done double-digit increases, as you can see here. So it's not just a doom and gloom scenario. There are pockets of growth in all of this. Now, critical in particular for digital is how quickly the small and medium-sized business market is going to recover. In contrast to other media where you have a fixed set of dozens or a couple of hundred advertisers, in digital we are reliant on a much more fragmented portfolio of advertisers. And you can see this here if you look at the share of ad spend, major blue chip marketers and small and medium-sized businesses. We can see overall in Europe, we are reliant on major marketers, similar to the US. But if we look at traditional versus digital, at the middle chart here, you can see that the share of digital spend by major marketers under indexes, whereas the share of digital spend by small and medium-sized businesses, in particular on self-serve platforms, massively over indexes. And if you look at search, for instance, you can see that the majority, really a vast majority, comes from SMBs, and it's similar for social. So those businesses, the health of those businesses, the ability of these businesses to operate is critical for continued ad recovery. So that's why we've seen so much government stimuli on these initiatives, and why, if you think of the big platforms, they've been providing programs, payment deferment programs, creative support, etc., for these businesses, because SMBs really make out so much of the digital economy. So how's the road to recovery going to look like? Now, if we look at the past recessions, it will take us 3 years minimum to return to pre-crisis levels. So here we see indexed at 100, the ad spend recovery on the left from the dot-com crash, 2000, 2004. It took 4 years. Then we saw the financial crisis, 08, 09. And again, we did see a recovery that was quite steep, nearly V-shaped, as you can see here. Apart from the Eurozone, which had its own Euro crisis, a double whammy, if you will. Then if you isolate the Eurozone crash, again, a V-shaped recovery, but that V took a long time, again, 3 years or so. And if we look at what's happening right now from where are the markets right now, indexed at 100 from the point when the financial crisis of 08 started, well, some markets haven't even recovered from that yet. Romania is in a relatively good position, as you can see here, where 2019 it indexed at 104, which is on the same level as France and Germany when it comes to the recovery from the recession. So this is a fairly positive, a fairly healthy picture for the overall market recovery. So if we look at now what's happening in 2020, now we need to look at, first of all, the employment rate. Because currently the main impact was frozen spend by marketers due to uncertainty. It was a lack of supply. Advertisers didn't want to advertise because they didn't know what was going on. They needed to mitigate risks. But we haven't really seen effects on consumption yet. Only right now we see rise coming through. We see furloughing schemes from employers running out. So the impact on the real economy is only just starting. And you can see the anticipated rises in unemployment here in this chart. And this is even underestimating it, in particular, for instance, in the UK, where the official data is fairly positive, but it lags a couple of months. So we're going to see an explosion here. And this is one of the biggest risks for ad recovery. Nevertheless, in our baseline scenario, we see that all ad markets in Europe will return to growth in 2021. So no continued downturn. And on the right side, you can see by how much we anticipate each market to recover the 2020 losses in 2021. Still, in 2021, we'll have a gap. We'll have around 8.3 billion euros less in the ad market than in 2019. Now, digital recovery will be much faster. So the 3-year plan for recovery that we see across all media does not apply to digital. We see a much faster recovery, which will essentially just take us a year. So give and take, in 2021, we'll have recovered the losses in incurred in 2020. So a much faster return to growth. And this, of course, relates to a much bigger opportunity for digital, which is taking advantage of a structural shift that's happening right now. We've seen a long-term change in how media budgets are being allocated, as media consumption changed, as the value of different media channels changed. But there were always legacy commitments. Change was gradual, not sudden. And in some senses, too slow. It was lagging the realities. Now, what usually happens in a recession is you move from gradual change to sudden change. And we can see the sudden change right now, a faster acceleration of digital transformation, of digital change. And that will also empower a stronger digital ad market as we move out of this recession. A great example is e-commerce in America. In the US, we saw very slowly over the last 10 years, e-commerce rise to around 17% of overall sales. And within the last week, it increased from 17% to 28%. Massive change. And it's this period of fast changes right now that really plays to the favor of digital advertising. Now, overall, we see, again, driven by digital, but lagging other media, a return to pre-crash market in 3 to 4 years. Now, as I said at the beginning of my presentation, we do not really know how the future will pan out. There are many different ways of what's possible. So this is why I delivered some scenarios. And these scenarios show how the recovery would look like. We have a baseline scenario right now with a recovery in 2021, but then a very weak return to growth. We have a new outbreak if we have a new outbreak in 2021, we'll see steeper crash, we'll see a different pace of recovery as well. Longer outbreak in 2020, massive cut, then a slightly stronger rebound. And if we have a combination of those two things, we really have the double whammy. We do not know what's happening right now, but we need to keep these 4 options open. But from right now, the baseline scenario looks most likely. So next steps. If you would like to have those slides, we'll make those available. And I'll continue to model and assess different scenarios over the next weeks and months and provide all the national markets in Europe with updates. If you have any questions, please do feel free to reach out by email, by LinkedIn, and I'm happy to share my views and assist in any way possible. And with that, I want to thank you for your attention, and I pass back to Joanna for questions. Thank you.
Thank you very much, Daniel. Great presentation and great insights. Just wanted to ask you a question and to open the floor and to invite all the attendees, if they have questions, to either write them in the chat box or to unmute and ask the questions to you themselves. But I have one question. What do you think that lies behind the slower decrease in countries like Serbia or Hungary? Because in the beginning, you forecasted a 1-digit decrease in the ad market compared to a double-digit for the rest of Europe.
Yes. Yeah, this is mainly related to the IMF economic forecasts. The GDP forecasts for those countries have been more positive than for others. So you usually have an amplification effect, which means for every point that GDP declines, the ad market declines around between 2 and 2.75%. So it's a multiplier of 2.75. And the IMF GDP forecasts for Hungary and Serbia were much more positive than for other markets. So here, our forecast, our knowledge right now is strongly influenced by and limited by what macroeconomic forecasters think about the overall economy in different countries in Europe.
Thank you very much. We have another question. Is there any forecast data or point of view about impacting directly local publishing? What about local publishers or local players?
That's a great question. And I haven't done those forecasts yet, but I've reviewed more data that has been coming in. I myself work with a couple of publishers here in the UK, and I see their programmatic spend, for instance, and I can anecdotally tell you it's down between 30, 33, 40% on year right now. We do not see digital isn't equal, which means not every digital medium, not every digital channel is exposed. And I fear between the world of the walled gardens and the open internet and the world of the walled gardens and local publishers. Recovery for local publishers seems to be slower, and the impact seems to be higher. We already knew that there was a divide that had happened and opened up further and further over the last couple of years. But again, a recession is always a point where existing trends get multiplied. So there is going to be a bifurcation, and I would expect, even on the digital side, some traditional, some local publishers to perform more in line with traditional media than with digital. But there is strong hope, in particular, I think sales model innovation is key. Providing, managing your prices, providing attractive deals, being highly reactive to the market, so that if recovery comes, it can come immediately. And but overall, the recovery benefits the big guys.
Thank you. One more question. What do you think about brands to consumers? Do they have the strength, enough strength to contribute to recovery of the digital ad market?
What do you mean by brands to consumers? Do you mean direct consumer brands?
Yeah, exactly.
Yeah. Again, that's an interesting question. Direct to consumer brands were really, as you know, they exploded over the last couple of years, and they have become some of the biggest contributors to the digital ad market. For instance, if you look at Facebook ad spend, there's a food supplement company called Huel, H-U-E-L, and that was the biggest ad spender on Facebook So they spend loads of money on advertising. They are, in a way, from a business process perspective, much better positioned for this recession, because lean processes, everything is digital already, and we've seen that their strategies have been copied by many small businesses. There's been an explosion in Shopify stores, for instance, in companies for the first time moving into e-commerce, for instance. So this is all helping and bringing long-term e-commerce and advertising, so the purchase and the activation, much closer together. So this is great news for outcome-based advertising. Digital to consumer brands are often venture funded, which means they are more profitable. They need to advertise in order to survive. Advertising sits differently for them on the balance sheet. It's not a discretionary expense, but it is a necessary cost of doing business. If you don't advertise, you die because you don't have a brand, and no one will know about you otherwise. So they will have to continue to spend. But the huge risk is that some will not make it through the recession, in particular if they offer products that people are not purchasing on a recurring basis. Funding might run out, investors might turn away. So there's a huge risk in that sense for the D2C market, and we've seen some D2C brands going bust. For instance, if you think of things like Casper mattresses, which wanted to do an IPO, which was then cancelled due to a huge backlash, there's some risk in the D2C brands. However, if you have a subscription model focusing on goods of daily use, of things that are practical and useful for a new normal world, you're potentially in a better position than many other businesses.
Thank you very much. We have another question.
But overall, so the question was, can it contribute, can it lift the overall ad market? I don't think the segment is big enough to lift the overall market, but some players will contribute to stronger growth in digital, yes.
Okay, thank you. Is it possible to have a more detailed forecast on industries, platforms like format, video, search per countries?
Yep, we are currently working on that, and that should be available in June. Okay,
thank you. And I assume that we had another question on any recommendations towards a healthy recovery aiming at small players. That I assume that it is similar with the direct-to-consumer brands.
Yeah, I mean, on a player basis. I mean, if you look at the publishing side, now is the time to come together. Now is the time for alliances. Realistically, when I look at the UK, many staff have been furloughed, and I don't expect everyone to come back. So publishers will need to operate in a leaner manner. And now is the time for collaborations and initiatives to pool resources and to get more scale. So I predict that publisher initiatives, publisher alliances will gain more traction as we come out of this recession. For some players, when it comes to the agency side, I think there's a huge potential in here actually. Because we've seen some of the holding groups come under pressure. We've seen a rise of in-housing. And if you offer specialized services, niche services, on marketing transformation, on programmatic, if you offer outcome-based buying, that's a really, really strong and important niche that independents can occupy. When we look at the buy side, the advertisers, recommendations for small advertisers. In previous recessions, many people in the ad industry were always producing lots of studies saying you should advertise in the recession, you should be anti-cyclical. Now, this is in some cases more like a war-like situation in a typical recession. So this advice doesn't really hold anymore. And I think it's dangerous to tell every business you should be advertising right now when literally their financial existence is on the line. So it has to be done on a case-by-case basis. But what can be done to help smaller advertisers is to provide strategies that deliver outcomes, provide immediate outcomes, acquire customers. Think of innovative payment terms. What I've seen is, for instance, move away from a model that you buy CPM at cost, but then you have an outcome-based success fee, for instance, like this. If you budget and want to get advertisers to defer payment terms, to offer creative support and solutions, something we've seen in the digital world, but also in the TV world, where some broadcasters are offering their clients to take over the production of their spots, for instance. So there are many ways how you can incentivize smaller advertisers to de-risk their ad investment and to continue to spend during this recession while being creative with business models and adding value-add services. I think those service providers, those agencies, those publishers who in this recession come out and give this extra help, they do themselves a favor for long-term commitment of their clients. We all know how highly fluctuating client bases are, constant pitches, etc. Right now is the time to establish more strategic, deeper relationships beyond being a mere provider of creative and media to a strategic partner that helps to navigate the business through the crisis. So it's the time to get really up and close with your customers right now.
Great answer. I really love your insights. What do you think is the role of an organization like IAB on this road to recovery?
Great question. I think there are a couple of things. First is education. So making the market aware of what's going on, providing impartial, unbiased advice on where the market is going. Then, secondly, providing recommendations and instructions on how a recovery could look like. So not just observe, but help to shape the recovery. And we can do that in several ways. Number one, examples and case studies of successful brand strategies, of successful agency strategies in this recession to share across markets so we can find best practices and new ideas. Secondly, on the political side, help lobbying, help support for tax favors, for supports for the ad industry, which is happening in some markets. And thirdly, also bringing the industry participants together at a table to find joint solutions, to bring buy and sell side closer together than they were before. And I think this will become particularly important now that as we move out of COVID-19, we'll of course have the post-cookie world to deal with. So helping to shape the recovery through industry standards, through policy, etc., is also going to be important. And that's an area that we're working on very actively at the moment.
Thank you very much, Daniel. We now have a homework. It seems that there are no other questions. So I thank you very much for your time.
Thank you all for listening. Thank you all for the great questions. They were really good questions, some of the best I've had. So much appreciated. Thank you.
And for the rest of the audience, you can hear more of Daniel's presentation, and I think that some updated information on the 3rd of June during the Interact online conference.
Correct, yes.
Okay. Great, thank you very much, and we'll keep in touch.
Thank you, have a great day.
Thank you.
Bye, guys.
Mulțumim tuturor pentru participare și pentru înscrierea la Interact. Veți primi și pe e-mailul nostru datele de înscriere. Dacă ne urmăriți și pagina de Facebook, vor fi și acolo informații. Pentru orice alte detalii, informații și prezentare, vă așteptăm cu întrebări și cu e-mail-uri. Mulțumim frumos și vă doresc o zi bună!
Mulțumesc! Asemenea tuturor!